Thank you very much, David, and a big thanks to Sustainable Financial Markets and the SIPC for hosting this. And hello, everyone, and thanks for joining. I'm going to spend about 15 to 20 minutes laying out the work that we're doing, and then very keen to get people's feedback and input on that because it's work in progress. We're going to launch the Green Light project and a major report for pension funds in late October. So this is in formulation right now, and your input will be very valuable. I'm here with my colleague Louise Rouse, who's our Director of Engagement. So I'm going to take a couple of minutes just to explain who ShareAction is, and then a few moments on the kind of project model that we are adopting for Green Light, and then spend most of the time digging into the specific recommendations we are intending to make to pension funds around how to transform themselves into climate-conscious investors. So just kind of flagging up that this Green Light project is, we're based here in London, and the Green Light project is primarily focused on changing the behavior of UK pension funds, but we've designed it from the outset to be applicable and useful and engaging to people around the world who face the same issues, and very conscious that climate risk is one that UK pension funds can't work on alone, and we need kind of global as well as national collaboration on that. So ShareAction, which was called Fair Pensions, and some of you may know us as Fair Pensions still, and until we changed our name in March of this year, is an NGO that focuses in a dedicated way on the activities of mainstream investors and seeks to promote responsible investment in the mainstream. We play a role in the UK of scrutinising what pension funds do and what their fund managers do. We rank the responsible investment performance of pension funds, for example. And then we have a stream of thematic work where we, for example, doing a lot of work on oil and gas in the Arctic. We do a lot of work on living wages and labour standards in the UK economy, all kind of engaging the investment community to use their shareholder power in a constructive way. And then we have a major stream which involves empowering and educating pension fund beneficiaries and members to be engaged with what happens to their pension savings and how they can transform their pension funds into more accountable and responsible institutions. So all of that is kind of relevant and will come together in a way for this Green Light project. It's a 3-year project. As I said at the start, it aims to transform pension providers in the UK into climate conscious investors. We're focusing on asset owners, but are very conscious of how the whole service provider chain needs to be engaged. We think it's right to start with asset owners. There are, of course, pros and cons of that, and one of the things we're very conscious of is that many UK pension funds have very limited staff and capability to engage with new and challenging themes like climate risk. So it's essential in our view to try and make this easy without making it excessively simplistic. And I would very much like to have the views of participants on the call around how to get that balance right and how to take account of the fairly limited staffing and capability on a lot of pension funds. Another thing to say is that we're very conscious of standing on the shoulders and drawing on the superb work that's undertaken by a lot of organisations in the pensions and investment space and in civil society. And just to throw out a few names, we're very grateful for the work that Mercer has undertaken, which is really informing this project, and Ceres over in the States. We're working very closely with Carbon Tracker, whose analysis on stranded assets has obviously been hugely impactful and shaping this debate in the last year or so. We have a long-standing and really good working relationship with Greenpeace, and the work we're doing on Arctic oil and gas has been involving those. And we've been reaching out to all of the members and the Secretariat of the Institutional Investors Group on climate change. So we are conscious that there's a lot happening in this space, and we're not seeking to replicate, but hopefully to draw together some of those good strands and present them in a way that can be digested and acted upon by pension funds. So We're also, I guess, conscious that there are some individual pension funds in the UK and overseas where there is some excellent work going on to think about climate risk, to think about investing in climate solutions, to think about engaging with the policy-making process. But the fact is that that work is kind of painfully slow, and the good work of a few leaders is not really drawing in the rest of the mainstream industry as fast as it needs to. So our analysis is that we do need a campaign, and a campaign that engages players outside of the investment and professional pension fund world, engages civil society in putting some pressure on to demand more and faster progress in managing climate risk and investing in climate solutions. And interestingly, our analysis is that civil society organizations that are really concerned about climate change have all come to the conclusion that engaging with capital markets players is critical, and it needs to be a part of the strategy of any NGO that's focused on climate risk. So I think there's a kind of coming together and recognition both inside the pensions industry and outside the pensions industry that we have to get progress accelerated and more action from the sector. So we're going to launch this project publicly in October with a report for pension funds, and I want to talk through that report and the recommendations we're intending to make for the next few minutes, and then open it up. We will release at the same time as this report for pension funds a kind of parallel manifesto for civil society allies, for NGOs, unions, faith organizations, and for individuals, which kind of helps them to gain access into what we're talking about and engage with their own pension providers on these themes. And associated with that, by the way, we're training individuals to be green light advocates so they can take these messages to their pension fund. And if anyone would like to join that training, the first one is on the 14th of September. So over the summer, we've held 4 workshops to bring together a range of experts to help us work out recommendations for pension funds in 4 key areas. And this report will have a kind of waterfall of recommendations, some kind of easy sort of entry steps for pension funds that are maybe not doing very much at all at the moment, and then some more stretching recommendations and asks for those pension funds that have taken first steps but could frankly do more, and we want to help them and encourage them to do so. So I'm going to focus on the kind of more stretching asks in each of these areas, and then there may be time to look at some of the easier steps in the question time that follows. So the first is around the fact that pension funds need to assess their financial exposure to climate change, their portfolio exposure to carbon, their exposure to regulatory risk, and their exposure to the physical impacts of climate change. And we are minded to propose that pension funds undertake some carbon footprinting and devise action plans to reduce their climate risk exposure year by year, and to report annually on the progress against that action plan. So these would be individual action plans crafted by each scheme, which relate to their particular asset allocation and their characteristics. But we think every fund should have a footprint, an action plan, and report against it. Now, we are very conscious of the pitfalls with footprinting and the fact that the progress is needed around the methodology, and we've been struggling with that. We'd very much like some input on that from the discussion, but we kind of feel convinced that it should be part of the story, because understanding where you're at and how you're going to make some progress kind of needs to be the first key step. So the second set of recommendations is around what to do with carbon-heavy portfolios, and we are going to concentrate on fossil fuel holdings and then separately on non-fossil fuel holdings. When it comes to fossil fuel holdings, we think there is a good case to ask for divestment from pure play coal holdings, active holdings in pure play coal. But we're going to put even more attention on demanding that, or we're recommending that pension funds undertake proactive stewardship on the capex of their oil and gas holdings, and make sure that they are stewarding those companies away from major new capital allocations into exploration and exploitation of new sources of burnable carbon. And again, we'd be very interested in people's analysis of that. We sense that there's actually a lot of disappointment actually around some of those fossil fuel holdings as income stocks, and kind of returning the capital to investors could actually be quite a popular call, and clearly one that would help to reduce carbon emissions in the future. In relation to non-fossil fuel holdings, we think mostly we're going to concentrate on energy efficiency, where there are some real win-wins, but not enough engagement by the asset owners at the moment. We have thoughts on bonds, but would be very interested in feedback from participants on the call about what to recommend pension funds do around their bond holdings. And finally, in terms of a recommendation for passive equity investors, looking at carbon tilted indices, and think that there's a role for recommending those. Again, thoughts required, because clearly they're not a kind of perfect silver bullet solution by any means. So the third big area is climate solutions and investment in green tech, renewables, and developing world adaptation for climate change. And we're minded there to propose that pension funds work towards a target for investment in climate solutions. We are yet to really nail down whether that would be a target for the UK pensions industry as a whole, or whether that would be a target that would apply to each and every pension fund. But we think that they should be working towards, over time, achieve an allocation in each of their portfolios to climate solution investments. And the fourth key area is around public policy. And again, the leading pension funds have been active in this area, and we commend the work of the IIGCC. Indeed, we think we're going to recommend that in the UK, more pension funds join the institutional investors group on climate change. However, the main kind of policy-making voice for the pensions industry is the National Association of Pension Funds, which has done very little in this area by their own admittance. And we would like to see pension funds pushing on the National Association of Pension Funds to be more engaged and to really collaborate with the Institutional Investors Group on climate change. We think a key area, and again there's kind of rising appetite for this, is for pension funds to be proactive in countering the lobbying of investee companies who have an interest in the status quo and who are undermining local, national, and international agreements to address climate change, because that is, in our view, undermining the financial interest and the sort of the best interest in terms of future quality of life of pension fund beneficiaries. So being a bit more proactive about countering that lobbying would be a final recommendation. When this report comes out, there will be pieces on the need for trustee education, and as part of the project we'll have solutions on that and be providing some training in conjunction with some partners. There will be questions and toolkits for consultants and for service providers. So there'll be lots of tools that try to make this easy and helpful for pension funds. And again, we'd very much like your thoughts on what do you think are the key tools that really help pension funds to get into this in an accessible, easy way, as well as having your reactions to the recommendations I've just outlined. So thank you for tuning in and listening, and I look forward to the discussion that we're going to have in the next 25 minutes. Over to you, David.
Great. Thanks very much, Catherine. There's a few questions that have come in, so I'm just going to read them out loud, if that's okay for you.
Sure.
This one's from Charles Erkelens. How do you rank the companies? What indicators do you use?
We are just doing a survey of pension funds, a ranking of pension funds right now, and we have a whole bunch of questions about how they integrate ESG factors into strategy, asset allocation, manager selection, and we make that survey and the questions in it publicly available. We'll be publishing that ranking and the survey questions that were asked of funds towards the end of the year. But if you check our website, you can see the last 2 or 3 surveys that we've done, which rank some asset managers and insurance companies providing pension products. So all of our material and the methodology behind it is available on the website.
So Catherine, what actions do you think funds investing in tracker funds and/or index funds, especially common for DC schemes, can take in relation to climate risks in their funds? Disinvestment from fossil fuel assets not open to such investors. Are you able to answer that fairly long question, Catherine?
Yeah, I certainly am. So clearly, a huge amount of money has moved into passive and trackers from the pensions industry in the last few years, and we're very conscious of how to ensure that there are good solutions for them. So that's why I raised carbon tilted indices. That's one part of it, but equally important is that in passive funds, it's still vitally important to use your shareholder voice and to undertake engagement with individual holdings to push them to reduce their own exposure to climate risk, to increase their own energy efficiency of operations, and to use shareholder votes as appropriate for that agenda as well. And you know, some very good work is taking place by some of the major passive investment houses around that agenda. And then the other thing that it's critical for passive investors to do is to be involved in the policy-making process and having a strong voice in investor networks that address climate risk and have an intelligent, well-informed, well-researched, consistent dialogue with politicians and policymakers.
Thanks, Catherine. We have a question from Joy Williams. What about addressing the issue of convincing investors that it is a real risk? Once they are convinced, then that is a more productive discussion on what they can do. Do you have any thoughts on that?
Sure. So, you know, there is an element here that you know, there are some that are so deeply skeptical that it's kind of difficult to have a completely rational conversation. But nevertheless, it's absolutely critical to shepherd all the strong evidence that does exist around, first of all, the realities and risk of CO2 concentration in the atmosphere, and secondly, the financial implications of that over the long time horizon that is relevant for pension investors. And this report will be bringing that evidence base together and presenting it in, I hope, a reasonably succinct but compelling way. So it's important to really make that case from first principles, present all the evidence. But I think we also we're kind of looking to engage with pension funds who, you know, maybe do accept that evidence, but are a little bit kind of stuck on, okay, so what are the practicalities of what I now do to address those? So we'll spend some energy, but not too much energy, just trying to convince people on the fact that there is risk here. And again, that's very much an area where we're drawing on the excellent work, not just inside the pensions and investment industry, but actually in the wider economics profession and in the wider scientific community. There's some very good work. Obviously, this is very timely in the sense that the Intergovernmental Panel on Climate Change will be producing their 5-year assessment in stages, but from September, and I think that's going to make it very apparent just what the seriousness of what we're talking about, put this topic in the headlines in a really, I mean, it doesn't really come out of the headlines too much, but I think it's going to really ramp it up. And then, you know, the lifetime of this project takes us through and a bit beyond the global negotiations in Paris at the end of 2015, where heads of states will try to hammer out an international deal. And I think if the investment community can signal that it is serious and long-term investors like pension funds are serious about moving capital away from high carbon investments that lock in emissions into the future, that will send a very important signal to global policymakers.
Great, thanks, Catherine. This question refers to the original Mercer report that said that disruptive climate change won't appear for decades. If one makes the logical assumption that we won't see policy until we see the impacts, where's the risk to companies operating in the 5 to 10 year time frame?
Well, I think we're already beginning to see. So, I mean, the major disruptive impacts of climate are probably, are yet to come. But it's quite apparent that there are already some impacts making themselves quite apparent. There's a very good piece out in the UK in the last week on stranded assets in the agricultural sector and the exposure of the agricultural sector, which of course is land and agricultural investments is an asset class that pension funds are moving into more, but there is already quite significant exposure to that. I think people underestimate the fact that already there are, as not as much as some of us would want, but there's already policy intervention that is driving change in the business environment. So there's a number of things that are already with us, but the key thing is that pension funds need to be alert to risk over a time horizon that's relevant to their beneficiaries. In the UK, we're about to have, well, we already have, and it's gathering pace, pensions automatic enrolment. That's bringing 9 million new people into pension saving, many of them young people. And part of our case is that for people in defined contribution schemes who are 20 and 30, in their 20s and 30s, it is really poor management for schemes not to be alert to the risk and the implications for those young savers.
Great, thanks, Catherine. Another question, do you also focus on social sustainability issues at all?
We certainly do. Yeah, we're doing, we've done a major project in the last 2.5 years to secure living wage standards in the UK operations of FTSE 100 companies, which is the 100 largest companies on the London stock market. That's made a huge difference to the lives of many thousands of low-paid workers in the UK economy. We've done work on with partners in the States around trying to ensure that global telecoms operators have a human rights framework in countries like Egypt. Actions over the weekend in Egypt, people, and that project actually was triggered out of the protests in Tahrir Square a couple of years ago, where Vodafone and other companies that are staples of UK pension funds shut down their networks, causing loss of life. And so we have a number of different activities and probably have as much emphasis on social as environmental. I think we would see climate as a social as well as an environmental issue. We think it's kind of probably the major fundamental risk facing pension investors, or ESG risk, which kind of marries up both social and environmental considerations.
Great, thanks, Catherine. We actually have quite a lot of questions coming in, so we'll try and get through them as best as possible. I'm not sure if you'll be able to answer this one, Catherine, but I'll read it out loud. Is there a role for Global Unions Committee on Workers' Capital, CWC, and Shareholders Association for Research and Education in your consultations?
There's a huge role. We would very much like to have a dialogue. We kind of have a bit of a relationship. We'd like to deepen a relationship with both of those organizations. I said at the start that we think that although we need to shepherd the intellectual arguments and present the solutions to pension funds, change won't happen without organized members of schemes putting some pressure on from below. And the unions have a critical role to play in that. We're very pleased. I mean, half of our membership at Share Action is trade unions, and the other half is sort of NGO and faith players. And the unions are very engaged with this Green Light project, and we see them playing a key role. And we would love to reach out to Share and CWC on this project. So maybe we could, in fact, anyone who's on the call right now and would be interested in a kind of follow-up bilateral discussion, please do get in touch. I think my email is available on the SFM website. If not, it's on our Share Action website anyway.
Okay, we have a question here from Mark Trexler. Catherine, what is the risk message you're delivering? Is it climate change itself or climate policy? And how do you make that risk seem near term enough to matter to those decision makers?
Well, this is one of the interesting things about climate change, is that there's kind of risk wherever you look. So if we assume that there's going to be strong regulatory action, of course there's huge cynicism about whether there will be some decisive regulatory action, then that has huge risk implications for people's fossil fuel holdings. If we don't have strong regulatory action and fossil fuel companies get to burn what they wish, then that will have massive implications for the financial well-being of the remainder of people's portfolio. So, this is a kind of we feel an issue where investors just can't afford to put their heads in the sand, because there's a real need to try and head off and minimize those risks, but there's also a real need to understand how those risks play off against each other and how you hedge more appropriately that risk relative to other risks in the portfolio. So it's a mixed bag, and I hope that our report will help people to navigate through that quite complex landscape.
Great. Do you think there's an argument to be made that funds should reduce their number of holdings so as to be able to better research each firm? But would this reduce the benefits of diversification? It's a question from Kevin Cromash.
That's a debate that's actually been very live in the UK since the K review on long-termism in equity markets, where he recommended that more concentrated portfolios would actually be a good thing for pension funds and other major investors, and that the benefits of diversification have been, they're very real. Clearly, diversification is kind of essential 101 for pension funds, but there's a point where the benefits tail off pretty significantly, and it's certainly true that with more concentrated portfolios you can have more time really engaging and having a really kind of responsible ownership approach around the strategy, including on climate risk management of each individual holding. But I wouldn't say that for this report we're going to kind of major around that message, but it's kind of it's part of a debate that Share Action has been fairly actively involved in the UK in the last couple of years.
Catherine, how do you successfully reach out to pension beneficiaries to help increase pressure on their funds to take steps to address climate change?
Well, there's a number of ways. So one way is clearly through the trade unions. And the companies in the UK that have the biggest pension funds are, not in all cases, but in many cases, unionized companies with union-nominated people sitting on the boards of trustees of the funds. And the other strong base of union membership where there's big pension funds is local government in the UK. So the unions is one source, but it's not the only source, and we are building currently a pretty exciting, broad-based coalition of support in civil society for this Greenlight project, which includes Friends of the Earth and WWF and Greenpeace and some of the major development charities who have thousands and thousands of supporters who are very engaged with climate change as a risk issue and as a moral issue, actually, and who those organizations are really beginning to think we want to reach out and message our supporter base and encourage them to be active in the Greenlight project, emailing their pension fund. Share Action has an online resource which is a major database of all the pension funds in the UK, so you can just go to our website, you can find your pension fund, you can send them a message. So reaching out through civil society, both the unions and the environmental organizations and so forth, and the faith communities is kind of critical to building a base of bottom-up support in the membership of pension schemes.
Catherine, I have a question from Jane Ameshjir, I think from Mercer, I think. Hi, Catherine. There are a few similar strands underway between 350.org, Asset Owner Disclosure Project, and also your project. Do you envision collaboration amongst these? And what would be your ideal in terms of how this evolves?
Hi, Jane. Yes, I do envisage, in fact, we already are collaborating with both of the groups mentioned. We kind of have some difference of emphasis on some things with those groups. So 350 has a stronger take on divestment than we do. We see, there is a role for divestment at the margins in things like pure play coal and some tar sands pure play, but we are focusing on stewardship around CapEx expenditure in the fossil fuel industry. Although I have to say, I think 350 are kind of their thinking on this is I mean, their very powerful and effective public message is very strong on divestment, but actually, in reality, when we talk to them, we know that they understand some of the constraints for pension funds and are very interested in a kind of slightly broader range of tactics to achieve the same outcome in the end, which is using investor power to engage with the climate crisis. AODP, we've had a great, relationship and dialogue with AODP for a number of years, completely consistent in our message around there is a real need for accountability by pension funds. Greenlight is all about that. We don't think disclosure is the whole story, and that's why the Greenlight report will have substantive recommendations about what pension funds do to address those risks and to transition investment into climate solutions. But again, to be fair, AODP is also focused on solutions as well as disclosure. So yes, we do, and I think it's really critical that different players in the NGO space who share an interest in this theme do collaborate and support each other.
Catherine, what are the low-hanging fruits in linking between climate change and best practices in pension funds?
I think some of them are around just really making this issue one that you move on to the agenda of the conversation you have with your investment consultants and with your asset managers. I mean, I really do think that there are some things that asset managers could move up the agenda in terms of the engagement they have with companies pretty easily, but until they're asked to do that by pension fund clients, it isn't going to happen. So I think, pension funds, we hope will get really engaged with this, but this report will have some pretty easy steps, which mean that a very busy pension fund that's struggling with deficits and all kinds of other priorities and hassles can nevertheless really move down this track and do some meaningful action, and frankly put a lot of the burden for activity onto its service providers in the asset management community. So I don't think we need to say that. I think it's very important to spell out this isn't overwhelming, this is very doable for pension funds, and that okay, this isn't an easy topic. Really addressing climate risk is going to take years. It's going to take huge collaboration across the investment community. It's going to take huge kind of and creative thinking and boundary breaking thinking, but there are some first steps that you can take and they're not that difficult.
Catherine, this is a fairly challenging question. I'll throw it out to you. You're suggesting divestment from pure play coal equity holdings. Why would pension funds divest right now after last 12 months price losses at many coal miners, for example, Peabody, Arch Coal, and Coal India?
Investment advice here, if you like, but I think there's a real reason why those holdings have been falling, which is it's not a strong and sustainable market, and in the case of some of those companies you just mentioned, they're really challenged, and they're challenged on a permanent basis now by shale gas and by other lower carbon forms of of fuel. So, you know, I think that the smart thing clearly would have been to move out of coal some time ago, but I don't think coal's going to recover. I hope it's not going to recover. I think there's a lot of people in civil society committed to ensuring it doesn't recover. And so the advice to move out of pure play coal is driven both by a financial analysis and a climate analysis on our part.
And how do you successfully reach out to pension beneficiaries to help increase pressure on their funds to take steps to address climate change?
I think I just did that one.
Oh, I'm sorry. I just repeated. There's a lot of questions coming in.
It's okay.
There's a question about the Green Light campaign. What provisions are you making for using online tools for distributed education and engagement, including MOOCs and other forms of blended collaborative interaction beyond webinars to support peer-based and local action?
We are currently building a website right now, which will have a whole bunch of resources and links to all the other amazing organizations that are very active in this space. You know, we really want that to be a signposting place for interesting initiatives at all kinds of levels, including, as you say, a kind of very local level. We're really in the UK, local communities, and people got investments in local renewable energy investments. And, you know, I think we really want to showcase that whilst this project is about pension funds, and pension funds being very major institutional investors can operate at a very high level on this, there is a huge spectrum of investment base of that local. It's a real inspiration, and you have people that got together with their neighbors and others in a local community to fund a wind farm will be the kind of people that will also engage with saying, oh, and what is my pension fund doing to address the same risks and the same agenda? So we really want to draw on those kind of other networks. And online and social media is going to be completely critical for Greenlight.
And Catherine, is there evidence that what evidence is there that pension investors actually make long-term horizon decisions?
Oh, that's a good exam question. There's a lot of evidence that they struggle with it, to be honest, and there are a lot of reasons for that, which is, you know, the funds are delegated to asset managers who have a whole bunch of short-term signals and incentives themselves, and I think this is an area that pension funds struggle with, and it's also an area, fortunately, where there's some very good thinking going on in the investment consulting world and elsewhere to try and address that kind of deficit of long-term thinking that is kind of critical for good investment in a pension fund, regardless of climate change, but which climate change kind of makes absolutely imperative.
Okay, Catherine, I think we're going to take one or two more questions. There's a fairly long one here from Jim Osborne that I'll read out to you. Do you think that many of the challenges presented to the education and training of trustees dispersed throughout a fragmented multi-fund pension landscape would be made easier by the amalgamation of funds into a national collectivized fund under the management of the best experts and trustees we have, whose influence is currently diluted by the dispersed nature of the current landscape? Catherine, do you have any thoughts on that?
Yeah, I do. So I think that questions of scale and economies of scale are actually very relevant in the pensions landscape. So there's some really good evidence from the Rotman School in Toronto and elsewhere that big schemes, big pension funds are better governed, and that better governance leads to better investment decisions, and that leads to better outcomes for beneficiaries. So scale is important, but we've got to kind of start where we are, okay? And we're not going to get the perfect landscape in pensions in the time frame needed to address the climate crisis. So we are producing ideas and solutions for pension funds where they're at today, and beneficiaries where they're at today. And meanwhile, as an organization, we very much engage with those debates around governance and structures that and business models that are conducive to responsible investment.
So we're just going to wrap it up here a little bit. I want to let everyone know that this webinar has actually been recorded and it will be available next week on the SIPC website, which you can see on your screen. And actually, we have one more question here from Joy Williams. Catherine, that'll be a good way to kind of end this off. She wants to for you to repeat the key dates with the Greenlight project, and when can we look for the report or the website?
Okay, so one interim date is the 14th of September, when we're doing the first training day for Greenlight advocates, which is going to be members of schemes who want to be engaged with having a dialogue with their scheme and encouraging adoption of the recommendations. The main report for pension funds will be out in the week of the 21st of October. The exact date is to be determined because we're inviting some government ministers, we hope, to be attendant at the launch and speak about why this really matters to the UK economy and nation, as well as being relevant to the pensions industry. So it'll be that week, but I can't say exactly when, and we are obviously very keen to make that available to everyone through the Sustainable Financial Markets Network and also the SIPC. And if anyone is kind of engaged with what I've been saying in the last few minutes we've been together, please do get in touch with us, because we, as I said at the start, don't just want to answer your questions, but actually really need your wisdom and input around these recommendations and the process that we're trying to put together here.
Great. Well, listen, Catherine, I want to thank you so much for taking the time to do this webinar today. We had a fantastic turnout, and it generated some really, really great questions and discussion. So once again, thank you so much, and thank you to everyone for joining us. We really appreciate you taking the time, and we look forward to some more exciting webinars coming up in the next few months. So with that, I'm going to end the webinar and say thanks once again.
Thank you.